What goes up must come down. And for this business, the fall doesn't seem to be slowing down one bit. Once a bustling lunch spot for the urban office workers and quick yet fulfilling dinner spot for suburban families, both with long lines, the restaurants now stand mostly empty. The restaurants seem a bit dirtier, the service a bit slower, the portions a bit smaller, and the price much higher. Regular diners at this spot each have a different explanation as to why something feels off, but all agree this place is not what it used to be. It is no mas for Chipotle. Welcome to the Quality Investor. There is a lot of mixed data regarding the economy right now. Many consumer businesses are doing poorly, or at least not meeting expectations. I've discussed some of these already. Check out the earnings playlist at the end of the video. There are some businesses performing very well and smashing earnings. Layoffs are occurring. I saw a list the other day detailing which companies were doing layoffs and how many people were affected. If I find the tweet, I'll link it in the description. But based on the earnings reports I've read and the general employment tweets I've seen, there are two major themes emerging. But before we get into it, please like this video and subscribe to the channel. It only takes a second, helps us grow, and you can stay on top of all the quality businesses in the market. One is highly profitable businesses doing layoffs. The best example here is Amazon. Based on their current performance and future prospects, this move seems to be a trimming of the fat type cut. Basically, letting people go that may have been overhired or projects that the company decided to scrap. They are not due to negatives like margin pressure or trying to stop bleeding expenses. This seems to be true for all the big tech layoffs. The other theme, however, is layoffs at businesses that are legitimately struggling. Examples here are UPS and Target. Target is getting crushed by Walmart and the aforementioned Amazon. UPS is facing bloated overhead and unionization issues. UPS also lost major contracts from the aforementioned Amazon. In short, the companies that are facing issues are due to poor business execution or poor decision making, not necessarily from systemic economy-wide problems. Yet, the economic data is mixed enough that CEOs can still use it as an excuse to assuage investor fears from poor earnings results. I believe Chipotle is firmly in the group of a poorly executing business, but management is blaming the economy for their poor results. Scott Boatwright, Chipotle CEO, acknowledged Q3 underperformance amid persistent macro pressures, including declining consumer sentiment, reduced frequency from low to middle income guests, and the 25 to 35 age group. But as I mentioned in the intro, something is off about Chipotle. I used to frequent Chipotle about once a week for lunch. Now, this was pre-COVID when I worked at my old job in downtown Chicago. There was always a line out the door. Yet it moved fast, despite how busy it was. My burrito always seemed well constructed. Recently, though, Chipotle never seems busy. I can't remember the last time I stood in line. And it's not because of digital orders. Whenever I go, the workers are just standing around. There are no bags on the digital order pickup section. The food I order is either too big to fit in the burrito or barely any meat at all. And my burrito always falls apart in 2 to 3 bites. The tables are never clean when I go to sit down. Trash is usually left around. The whole experience has turned me off of Chipotle altogether. This personal anecdote serves as my thesis for why Chipotle is faltering. The quality, service, and ambiance have all cratered. The price increases have only deepened the issues for the chain. The lower income and younger cohorts have been pulling their spending back precisely because they perceive the poorer quality. They can no longer justify spending the money they do have on a product that is noticeably worse. Chipotle's menu prices have risen significantly over the last 10 years and have outpaced general inflation. A study analyzing 10 core menu items shows that prices increased by an average of 75% from 2014 to early 2024. This is a driving factor to either flat or declining comp sales throughout 2025. In Q3, comp sales saw a paltry 0.3% growth. Last quarter saw a 4% decline. Chipotle indicated that the 0.3% increase was due to a 1.1% increase in average check, but offset by a decline of 0.8% in transactions. In plain English, they increased prices yet again, and it was just enough of an increase that it countered the declining sales volume. Total revenues for Chipotle increased 7.5% to a hair above $3 billion for the quarter. Year to date, revenues are up 5.6% to $8.9 billion. But none of this growth was driven by comp sales growth. Like I said, comp sales were up only 0.3%. So the growth Chipotle did see was from the 77 net new store openings in the quarter, about an 8% increase year over year. Going further down the operating statement, we see operating income was essentially flat year over year at $477 million, but more importantly, margins fell about 100 basis points to 15.9%. Margin contraction is a telltale sign of faulty operations, and we've seen margin contraction in all of 2025. This is a trend now. The culprits are mainly store labor costs, which Chipotle derisively called wage inflation, and this other operating costs category, which was mainly due to marketing costs. And one thing to note, on the earnings call they mentioned much of the transactions they did have was driven by promotions, and they emphasized returning to share gains through transaction-led growth, not discounts. Another sign of a struggling business is when the CEO starts discussing a return to fundamentals. Well, Boatwright mentioned just that. And the fundamentals he mentioned were digital order accuracy, portion inconsistencies, and, like I've seen with my own eyes, cleanliness. What's worrying is that Chipotle executed on these basics flawlessly just a couple years ago. Before we turn to the valuation summary for Chipotle, let's take a quick look at their guidance. Shares fell sharply post-earnings, over an 18% decline to $32.53, in large part because of their guidance. In fact, Chipotle cut their guidance again after cutting it in the second quarter earnings release as well. The company now expects comp sales to fall in about the low single-digit range. This was after forecasting flat comp sales for 2025 in Q2 and comp sales growth as high as mid-single-digit growth going into 2025. This continual cut to the forecast has driven Chipotle's share price down a staggering 49% year to date. Chipotle has officially entered turnaround status as an investment play. So, what is the fast casual Mexican chain restaurant actually worth? Chipotle closed out the day at $30.56. They continued the decline since their earnings. We can see that big post-earnings drop here, over 18% after their earnings was released. They continued that decline here today with the broader market pullback, but you can see that the month has just not been very kind to Chipotle. They're down 26.6% in the last month, and they've just been faltering all year. They've yet to produce a solid earnings report in 2025, and this past earnings report, I think just the investors have finally had enough with their declining outlooks. And I'll be honest, I do not think it's going to get much better in 2026, and here's why. The company is projecting more inflation to their ingredient costs in 2026. However, it seems like Chipotle has reached the limits of their price increases because they're not going to raise prices in 2026 to offset this inflation. They mentioned on the earnings call that they might do very small sort of test price increases on targeted items, but not wholesale increases like we've seen before. So that's going to contribute to some more margin pressure into next year. The last 5 years, Chipotle has seen very solid growth. They've grown their revenue about 15.2% annually in that time. And that's coming off of a food poisoning scandal they had in the early 2010s. And they've been on a very nice tear since then. But things have certainly slowed down, like I said, in the past year. My projections now, I'm expecting store openings here to grow about 6.1% on the bear case up to about 6.7% on the bull case. This assumes very roughly about 300 to 350 store openings per year. Long term, Chipotle wants to get to about 7,000 stores. As of right now, they have 3,916. And then the food and beverage segment, I have that growing at about 6.6% on the bear case up to 9.2% on the bull case. So once we factor in that new store growth, so we're adding more stores to our denominator of the food and beverage per store calculation, we can see that growth there is not that much, about 0.5% on a bear case up to 2.4% on the bull case. It's not comp sales, but it is a loose approximation of that. But I believe with Chipotle, we've gotten into the territory now where they need to start showing real results for us to increase our projections for these types of revenue segments. Aside from the fact that whenever I go to a Chipotle, I can clearly tell that the quality and the service just is not what it used to be. The numbers are bearing that out in the earnings reports. So for me to increase my revenue projections, we need to see tangible evidence that the stores are growing transactions, that the stores are becoming better quality in terms of the cleanliness, that the food we are getting is well constructed like it used to be. And until they do that, I don't think it's fair to have aggressive growth at all for Chipotle. On a trailing 12 basis, their operating margin is down to 16.9%. I expect that to continue to fall over the next few quarters here. Aside from the fact they're forecasting comp sales decline next quarter, like I said with the price increases, they're not doing it. So that's going to put more pressure on these margins. Now, by year 10, however, I do expect the operating margin to be 17% on a bear case, up to 19% on the bull case. The last valuation I did for Chipotle, I believe I had my operating margins up as high as 22% on the bull case for Chipotle, but they were clicking in a lot more cylinders then. Obviously, I'm a lot more bearish now on the business. Free cash flow margin, I will say that Chipotle does a very good job of taking net income and converting it into free cash flow. For every dollar of net income they've earned, they've converted that to $1.02 of free cash flow. I'm projecting that to be $1.03 on the bear case, up to $1.08 on the bull case. So relatively stable to slightly increasing margins here for free cash flow, 13.1% on the bear, up to 15.7% on the bull case. Like I said, Chipotle closed the day at $30.56, and that brings their PE ratio down to 27. So they've had a pretty staggering fall in their PE ratio in 2025. Their 5-year average is at 67.3, their 10-year average is at 105.4. The forward PE is at 27.2, also pretty far below their 5 and 10-year average. So historically speaking, this is pretty cheap for Chipotle, but cheap doesn't necessarily mean a good investment. If we were to take the current share price, $30.56, and use it for a reverse DCF, the market is projecting 5.5% free cash flow growth over the next 10 years. A little bit below my base case DCF here at 8.2%, but it is more in line with my bear case free cash flow growth. And on that, I have a bear DCF here of $31.07, $37.28 for the base case, and $44.71 for the bull case. My exit multiple sits at $32.51. I am using comps of McDonald's, Starbucks, and Yum Brands. So we can see here, based on just the valuation average, there's actually a little bit of upside on the bear case and quite a bit of upside on the bull case. I don't think I'm projecting any crazy growth rates here. Chipotle's main issue is that growth has just slowed down considerably, and it might actually be a little bit worse in 2026. So we need to see Chipotle actually turn this around. And that's why we apply that margin of safety. Without any margin of safety, we have a $35.81 buy price, but we want a 20% margin of safety. In fact, given Chipotle's current state, I almost want to apply a 30% margin of safety. Either way, at 20%, it's at $28.65. And if we were to really be conservative here, a 30% margin of safety would put that buy price at $25.06 with a 22.34 PE. So Chipotle would have to come down quite a bit more to even consider as an investment. And to be completely honest, I don't think Chipotle is a business I want to add to my portfolio, even if it does come down to these buy prices. And the reason aligns with my thesis. I just don't think the restaurants are a very good experience anymore. I don't want to buy into a business if I don't feel good when I actually visit and patronize the business. If we see tangible evidence that Chipotle is turning around the quality of their stores, the food is getting more consistent, then yeah, we can consider it. But it would still have to come down in price a little bit more from where it is now. But without that evidence, I do not think Chipotle would be a very good investment right now. Thank you for watching today's video. And if you've made it this far, go ahead and subscribe to the channel. Thank you and happy investing.